So as we pick up with the U.S. demand, we always want to look at what's happening with that product supply, which is the demand metric that we're looking at with the EIA data. And it's not surprising to see, this averaging out in terms of where things are. But as we said last week and the week before, on the data, on the week-to-week numbers, we're going to increase. We're going to see this steady increase, and you can see it's moving at a very similar clip that we saw in 2021. Our view is that it's really going to level off in terms of where some of these flows are. 2022 started low, had a sizable move up, but that's what we've been talking about at this point, is that we're going to get to this level, and we've called it about 14.1, 14.2 million barrels a day, and then level off where we should be something closer as we progress through January into February. We should be much closer to about 14.7 to 15 million barrels a day of demand. And we're just going to be, let's call it anywhere between 600 to 800,000 barrels below what is quote unquote normal. And you're going to see that leveling off, and that's going to be a very continued view based on not only just where gasoline demand is, but, where's economic demand and where's economic throughput. We had a drop in retail sales. We had a drop, a pretty steady drop across the board. We had Empire data coming out showing that there was a slowdown on the manufacturing front, which indicates additional slowdowns on the ISM data. So again, you're just seeing these things that we've been talking about and like, look, here we are now, here are the leading indicators, this is the movement, and it's coming to fruition, which is why even though COVID, what is COVID at this point? I feel like people couldn't even spell it if they tried, just based on it's not really in people's minds to the same way. Flu season was crushed people November, December. And now you're seeing a bit of this reprieve, but you're still not seeing the increase in driving any more than, really well below seasonal averages. And that's going to continue because you don't have distillate driving you. You don't have gasoline demand the same way. And that's going to keep things well below normal. Distillate had a draw of 1.94 million, obviously, and it was driven by PADD 1. PADD 1 had a drop of 1.65, the big driver of where the shortages are. We don't see this pivoting all that much, and actually as it gets colder through the end of January with a potential polar vortex in February, you're going to see some sizable draws. And unless we get bigger imports or another kind of, special, if you will, colonial delivery on line 2, you're really going to see a lot of struggle on the PADD 1 side, which is going to keep prices a bit more elevated. Imports came down 60,000 barrels a day. You had a drop in PADD 1, but in order to address some of these issues, you're going to have to start to see some of these increases coming into PADD 1 to prepare for really that last leg of winter demand. Now, when we look at diesel front month cracks, you can see here that there was we're right at just below that 60, and that's where as we've been saying, we think we kind of hold here. And demand came up for distillate. It's still below average. It's going to fall again. But because of the storage situation, there's a lot of support for diesel cracks. So the question is going to be, if diesel cracks stay here, which is likely, where's gasoline cracks? Because if gasoline cracks remain weak, that's when you're going to see refiners really losing money and struggling to make a profit. And that's a likely scenario right now with more pressure coming, especially as gasoline normalizes a bit and gets into a tougher spot. PADD 1, you can see that the rate of change is pretty stable given where we normally have, because we typically have draws this time of year. But you can see we're just starting at the lowest ever. So even though we should be getting draws right now, you're just well below where we should be, setting a new record low, and that's going to help support some pricing, especially on the East Coast. Where PADD 3, you're starting above the 29-year average, and it's going to continue to drift higher. But we do see a lot of opportunity in the export market, especially as Russian flows slow, as the February 5th deadline nears, and we're going to talk more about that at the start of segment 3. When we look at the U.S. product supplied, you can see we're just falling below the 5-year average, and we typically have this spike, but we just think that we're going to be well below that 5-year. We have a little bit more warm, a little bit of the residual warm weather that's going to remain. Then it gets cold behind it with a potential polar vortex as we go into month end, into really the first week of Feb. So that could be supportive. But then on the other side, you have a big slowdown again on the trucking side, which you can see here. Trucking, again, came back down to about 50. And as we've been saying, we expect to really hug that 50 number. Could it go to 47 to 57? Sure. But again, it's going to stay at this level, which if you go back through from 2020 to 2021, that is 100 points off of where we have been in the past few years. So we just don't have diesel driving that demand as gasoline continues to remain underwhelming. On the rail traffic side, we've had a nice increase on the total carload side. As we said, chemicals is going to remain a big overhang. Coal is going to be supportive. Grains is going to be supportive. Metallics, motor vehicles. The biggest thing that we've also talked about is petchem and petroleum products. Petchem is going to be very weak, but petroleum products is going to stay strong because you're going to have to move these products into different areas, whether it's LPG or other. And that's going to be supportive while we continue to have a fairly sizable overhang on the intermodal front, just because inventories are more than well situated. You're seeing a lot of this concern from even small businesses and larger businesses that they actually have too much inventory at this point, which, again, is going to keep intermodal fairly de minimis and a problem. Now, when we look at the going out, so here you can see that there's a decent cold coming through, and it really kind of stops at the Mississippi, where you have this conversion from below to near normal up to the Mississippi, and then east of the Mississippi, you're above normal. And then that starts to dissipate as that cold continues through. I feel like I need a green screen behind me as I'm pointing. It's like, as we see on the weather map. But, when you look at this pivot, we do see more of this cold, and that's why we get that pretty sizable winter storm that's going to cut through, starting from the Rockies, coming across, which is going to, I think, impact demand a bit on the gasoline front. And then we get some decent cold. Now, the polar vortex is setting a record for how cold it is. The question is going to be when it dips down. We're seeing it in Europe, and there's a likelihood that we're going to get that in the end of Jan, beginning of Feb, which should be a nice little bump on the propane, nat gas, as well as heating oil side. Now, when we look at gasoline, you had a sizable build of 3.48 million, but that's still 19 million below the 5-year, 16 million below year over year. But you can see the rate of change is accelerating. We should see that continue higher, especially when you look at blending components, showing an increase of 3.97 million. That's only 11 million below the 5-year, and that's usually a very good gauge of where we're going to go. Gasoline imports still remain robust. It's increased by 40,000 barrels a day. That's 158,000 above the 5-year. And it's just given where, tanker rates have gotten better in terms of they come down a bit. We're starting to see that change as some of these floating diesel barrels from Russia get stuck. But right now, just based on what is en route, we should see those imports remain a bit elevated, which is going to help support us and really move us. I think, the likely setup is we close somewhere closer to where we were in 2021, that green line, that dark green line as we go higher, just because that's, and especially when you look at it, the comps get easier as you progress through March. And I just don't think we're going to see that demand that we have in previous years. So even if we don't, crest and get to the highs that we normally get to by end of Feb, beginning of March, we're not going to see the same kind of demand increase in March, which is going to put us right back into the mix when you look at those average numbers. Now, when you look at blending, again, we see this accelerating, especially because petchem demand just isn't there. So that is going to dump more into the blending pool. Now, when you look at Gas Buddy was pretty close. When you look at what the EIA came out with 8.05 million barrels a day of demand, they were at 8.144. So again, a bit closer to where we think we're going to kind of hug, which is that 8.2 million barrels a day of gasoline demand. And that's where we think that we level off a bit. We could have obviously get that hit because of the storm. And you might get a little bit of a bump because people fill up prior to the storm, and then you see that drop afterwards. But again, the weather is going to impact us and average us down a touch as we go through the next, really the end of Jan. But when you start looking at some of these demand metrics, so Asia Pacific ex mainland China, you've had a nice little bounce. That's normal for this time of year just because you have Lunar New Year. Clearly, it's closer to normal when you look back to 2019. On the European side, things are right back to where we normally are, as North America continues to be well below. Now, we think that that's going to remain the case when you look at that leveling off in North America. And then as Lunar New Year, people show up to their relatives, you'll see some of that slowdown on the Asian front. And then Europe, is likely to stay on a bit elevated side. We do have strikes in France, which is going to impact some of the demand. So we could see some of that paring back, but they're fairly close to normal. We've had a steady increase in gasoline prices over the past few weeks, and that's putting us back to about $3.38. That we don't see it going too much higher. Could it get to $3.50 in some areas? Yes, but realistically, it should start to crest right about here. And then as that diesel, as the demand diminishes, that's where we're going to see some of that diesel pricing soften a touch more. But you can see that the spread is going to remain fairly elevated at this point, just because on the storage side of diesel versus gasoline. And then back to the demand side. So you can see here on gasoline demand, it's actually in lockstep with where we were in 2021. We think that the rate of change levels off, continues. It will be above 2021. We're by no means saying it's going to reflect 21, and it's going to be closer to where we were in 22. But as we've been saying, it's just going to be just below 22, but follow a similar trend just because seasonality is real. We will get the seasonality there, but again, that's going to be a bit hesitant. And it was interesting because we did have Martin Luther King weekend. That's a longer weekend. Typically we see a bit of a bump. We didn't get it. President's weekend is going to be the next one where we could see that sizable increase, as that is another snow period. Or should I say ski period, where you get a little bit of an increase, but we'll talk about that as we get closer. Propane, propylene, here you can see a drop of 1.97 million. But we should be dropping. The whole point is it's a drop that is much slower and the rate of change is softened. And a lot of this is being driven by the lack of petchem demand and the lack of heating needs, which is why we remain at an elevated level. Jet, small build of 450,000 barrels. You can see it's just below where we were last year. But then on the demand side, again, we're hugging right where we've said we would, and we don't see that adjusting in the near term. When you look at TSA throughput, you can see that we're coming pretty close to where we were on the 4-week rolling average. We're just above 2019 levels. The benefit for us is that it's good to see the TSA checkpoint passengers getting back to normal. The problem for anybody who has traveled is that it's on less planes, so you're getting crammed in, and that is creating these problems. So even though TSA checkpoints or passengers are better, we're still not seeing the increase in jet, just because you're not getting more flights. You're just getting people stuffed into those flights. But Eurocontrol area still remains well below normal, and we think that that's going to persist over the next few months, really. And you can see DSA passengers, hugging right where we were in 2019, 2020. So we see it, being fairly normal at this point as we go through the remainder of of at least this quarter. And then you could get some impacts just on an economic level, but some prices have been pretty competitive, so that's going to keep should keep flights fairly full. Global passenger flights scheduled for the 12 weeks ahead decreased 0.24%. Again, the number of passenger flights over the week of January 10th to 16th grew by 3% against the previous week. So really not too much to say one way or the other. And we remain fairly stable versus the rest of the area and where we have been in previous years. Open table, you're seeing in the U.S. things are slowing a bit, and that's what we've talked about. We expect that to continue to slow. So realistically, we see a lot of headwinds on the demand front, on the diesel side, on the gasoline side, and that even as we continue to see demand ramp up, it's just where are we versus where we're supposed to be. And and what we're seeing is that it's going to be disappointing versus some of the areas that we've been in previously, and keep some of those headwinds, and again keeping builds fairly elevated in gasoline, especially as imports come in. And then distillate, it's going to be a balancing act of exports from PADD 3, imports into PADD 1, but we see distillate continuing to be in a fairly bullish spot in regards to storage, even as demand continues to be a headwind. So that's what we have for you on the U.S. side. In the next segment, we're going to go deeper on the abroad and look at some of the recent data sets that have come out, both from OPEC and other regions.